Welcome to today's broadcast of In Conversation. Welcome to today's broadcast of In Conversation with Dr. Sherry Cooper. We'll be exploring the world of mortgages in Canada and why it's important to have a deep understanding of this topic. To guide us through this conversation, we're joined by Dr. Sherry Cooper. Dr. Cooper is a renowned economist, financial expert, and best-selling author with over 30 years of experience in the industry. She's also the chief economist at Dominion Lending Centres, Canada's largest mortgage company. In this episode, Dr. Cooper will provide us with valuable insights and expert analysis on the current state of the Canadian housing market, the impact of interest rates on mortgages, and the importance of working with a trusted mortgage advisor. We'll also delve into the services offered by Dominion Lending Centres and why they're an invaluable resource for anyone looking to purchase a home or invest in real estate in Canada. So whether you're a first-time home buyer, a seasoned investor, or simply interested in the world of finance, this broadcast is sure to provide you with valuable information and insights that you won't want to miss. So sit back, relax, and join us as we dive into the fascinating world of mortgages with Dr. Sherry Cooper and your host, the president of Dominion Lending Centres, Eddy Cocciollo.
Hello, everyone. Welcome. I have our landscapers outside, so I'm not sure if you can hear the rumbling of the lawnmower, but nonetheless, welcome to our April In Conversation with lots of questions around what's happening with interest rates. Although Bank of Canada didn't move them today, there is that thought, wait a minute, there's lots going on. What is actually going to happen with rates? And of course, we're going to try to answer those questions. There's so many different factors that's going on right now. You look at, inflation itself. We saw an uptick to 2.4% in March. There's the GDP stall, and this is extremely sluggish GDP that's going on right now. The forecast is 1.1% for 2026. I think that's the lowest of the G7. We have the labor softness that's happening. Our unemployment is at 6.7%. Although we're not having massive layoffs, there is tightening with hiring. So that is playing a factor. Of course, there's the wage growth. So that is throwing a sort of wrench in the thoughts of, how do we get into that 2% sort of target rate when inflation is happening on wage growth. And of course, the Trump factor with Kuzma. I think, Sherry, we hear more about Kuzma 6 months ago than we have lately. I mean, we're coming up to this deadline with our trade agreement, our most important trade agreement, but yet, we haven't heard anything really of substance. And then finally, the geopolitical, the Iran war. I mean, that is throwing another sort of wrench in the thing. So needless to say, not a dull moment for you, our economists, on trying to figure out and juggling all these balls and giving us some updates today. So as usual, we'll go through your entire presentation. For those that are watching, if you do have a question, please ask it as you think of it. I will get to all the questions by the end. So Sherry, no surprise about keeping things the way they are on interest rates, but lots going on.
So much going on, Eddy. And I think the reason we haven't heard so much about Kuzma is that the United States has stopped any discussion with Canada with respect to the tariffs and the free trade agreement. And clearly, those two factors are very, very important to our country. And we don't know when the real negotiations will heat up, but they're supposed to be complete by July 1st, and it sure doesn't look like we're going to meet that deadline.
I don't think so. And what does that mean? I don't know, but I'm sure we're going to find out. So Sherry, looking forward to your presentation. Again, if you have any questions, fire them off. We'll get to them. Over to you.
Thank you. Thank you so much, Eddy. Well, of course, we are in a situation that we thought it was complicated when we met 8 weeks ago, 6 weeks ago, whatever it was. But since then, we're in the midst of a war, which is having a very dramatic effect on the global economy. Now, let's talk about that. We're in the 9th week of a war that was supposed to last, 2 to 4 weeks was what we heard in the beginning. And now the latest development is that Donald Trump has not accepted the Iranian proposal and is extending the blockade of the Strait of Hormuz indefinitely. Now, this means that Iran is unable to produce its oil and to sell its oil to its customers, so they're storing the oil wherever they can find a place to store it. But there's a limit to that, and ultimately their economy is going to be in a state of deep recession. And whether or not that allows them to begin to negotiate in earnest enough that we could see oil start flowing again in the strait, that is a very big uncertainty. Even if they were to decide tonight that a deal is done and they're opening the strait, it will take months to return oil to its previous price, because it will take months to firstly clear out whatever incendiary devices have been submerged in the strait, and also just to rev back up production to normal levels. So let's start with what we saw today. The Bank of Canada and the Federal Reserve both decided to remain on the sidelines. Neither did increase their overnight rates, despite the fact that inflation has certainly picked up. So let's move on to the second slide. The oil markets brace for the lasting turmoil in the Gulf, and the emphasis there is lasting turmoil. Supply disruptions in oil, gas, ammonia, nitrogen fertilizer, plastics, which are produced from oil products, helium and aluminum are all in short supply now, and their prices have risen sharply. Attacks on the infrastructure in the region have growing implications. Remember, Iran has been targeting not just Israel, but a number of the countries on the Persian Gulf, and including the Qatar and UAE. So it could take 6 months to return oil prices to pre-war levels. Now, when you look at oil prices, oil is not one product. Gasoline prices have surged, and we've all seen that at the pump, but indeed, jet fuel prices have gone up by the most, 110%, and diesel prices, which of course are moving the nation's trucking systems, diesel fuel is up 85%, whereas crude oil itself is up about 35%. So we're seeing an effect on consumers as well as business. Higher fuel prices increase the cost of travel, and the petrochemical shortages hit everyday life in terms of plastic products, plastic packaging, film and wraps, PVC pipes, consumer products, and more. So we're seeing in spades shortage of products and dislocation around the world. And the countries of Asia are suffering the most because they traded the most in terms of products that went through the Strait of Hormuz. Europe also has been negatively impacted. Now, this shows you that even though we're a long distance from the strait, obviously this has had a major effect on Canadian psychology. Canadian consumer confidence is at a record low. Now, the consumer confidence numbers have been declining now for months and months and months, but hitting a new low just tells you how important the Iranian war has turned out to be. U.S. consumer sentiment has also hit another low. This looks at the University of Michigan Consumer Sentiment Index for the United States. So consumers, I think it's safe to say, all over the world are unsettled by these dramatic increases in energy prices. Now, oil-driven inflation fears are pushing up interest rates. They're pushing rates higher despite weak labor markets and slower economic activity. So even though the Canadian GDP numbers, though positive, I'm happy to say, are still relatively weak, the oil price increases are driving up prices everywhere. And we've seen that most recently in the 2.4% inflation rate posted in March in Canada. The thing that may cause many of you to scratch your head, however, is what is doing well is the stock market. Now, not today per se, because today the markets are reacting to the announcement early this morning or in the middle of the night that Trump is extending the blockade for an indefinite period. Now, why would equity prices benefit from all this chaos and uncertainty? Why is the stock market shrugging off the Iran war? Well, for one thing, they expect a resolution of the war. For another, economic resilience is a positive factor, especially in the United States, where we see very robust corporate earnings. The mentality is to buy the dips. And AI sentiment has improved. So global liquidity has picked up sharply, and we see that the stock market and the improvement in household wealth is an important offset to the negative effects of all this destabilization. The question is, how long will this last? And the answer is, no one knows. But any extension in this situation is a big negative, and we know it's going to take some time yet before Iran comes back to the table with an acceptable offer to the United States and Israel. That offer would have to include the elimination of nuclear capability by Iran. Now, that's the big sticking point, and we'll see what happens. But in the meantime, as I've talked about in previous sessions, we are more than ever in a VUCA world. Volatility, uncertainty, complexity, ambiguity. This unsettles consumer and business confidence and is likely to remain with us for most of this year. Now, Canada is resetting. Canada is in the midst of a major process of adaptation. The trade for Canada with the U.S. is uncertain. We don't know what will happen with the CUSMA negotiations. Canada's population growth has slowed to an absolute dead halt. Global conflict has pushed costs higher. It weakens Canadian and global growth in the near term. There's a strong demand for energy, metals, and other commodities, but those are now in short supply because of the war disruption. And on the positive side for growth, the AI investment is supporting long-term growth as businesses, both in terms of like artificial intelligence businesses themselves, as well as other businesses that are implementing AI, all are investing very, very significantly in that capability, which means much greater demand for electricity, the need, in fact, to build AI capabilities is putting even more pressure on global energy markets. Now, Canada, as we learned last night with the spring update in our fiscal policy, Canada is in a positive fiscal position compared to the rest of the G7. We have the best fiscal position in the G7. We're the only G7 country, by the way, that has a free trade agreement with every other G7 country. So that too puts us in a good position. Prime Minister Carney has been all over the world multiple times now, meeting our trade partners, potential trade partners, and we are continuing to enforce our ability to trade with the rest of the world through conducting major capital spending projects, like further extension of the pipelines and other very important projects. We've got prudent fiscal management. We have a lower debt to GDP ratio than anyone in the G7. And a sound financial system. So those things will bode well for us going forward. There's no question, though, that to replace the US as our number one trading partner is extremely difficult and damn near impossible, given that we have no other neighbor the scale and size of the United States that we could easily trade with. In order to trade in that size as the US, we would need countries like China buying our products. And that's beginning to happen in a significant way. But it's still, the jury is out on just how much of our trade with the United States can be diverted to other countries. Canada is still very important to the United States. We're a critical trading partner, but the US has been shifting more of its trade towards Mexico since 2010. CUSMA tariff protection is under scrutiny, and the result will be that Canada must attract new trading partners while still trading with the United States. Now, all the countries of the world are reducing their exposure to the US because of policy volatility. The tremendous uncertainty, the one would say the chaotic policies of the Trump administration, where he changes his mind from day to day what his policy will be. We've already seen that Canada's trade is shifting away from the US. We're buying more products, that's the red line, from the rest of the world, and we're buying fewer products from the United States. And we're also diversifying our exports. Our exports to non-US markets have increased, and transition slows growth now while building future resilience. So this shows you our annual forecast for the economy. In 2025, growth was at 1.75%, but we ended the year on a very weak note. with an actual contraction in fourth quarter GDP. We've yet to see the GDP figures for 2026, but suffice it to say that a slowdown in economic activity is underway, and in 2027, we expect a modest uptick. What is relevant here, though, is I'm not predicting a recession. And for sure, if someone told us that a year ago, let's say, that right now we would see oil prices about $100 a barrel and the global economy slowing, I would certainly have expected that Canada, having major trade disputes with the United States, would be in recession. So we are proving our resilience. Now, the employment numbers have been very soft. And we saw that in January and February, there was a net loss of job creation, and then a very small positive uptick in March. The unemployment rate in Canada now has been, in February and March, at 6.7%. We expect that unemployment will edge higher, but likely no higher than about 7%. But still, that's not acceptable over the longer term. And more layoffs are coming. This chart shows you just some announcements that were made this week. Microsoft announced that it was offering voluntary retirement to 7% of its US labor force. Meta says they're offering to terminate 10% of workers, and Meta said that it would not fill 6,000 current job openings. And closer to home, we've got Rogers yesterday announcing that it's offering buyout packages to about 10,000 staff, half its workforce. So as companies pour billions of dollars into data centers and AI infrastructure, more workers are being laid off, most notably entry-level workers. And that's where the young college graduates come in. Many of them looking for jobs now are finding it very difficult. More people expect to lose their jobs. In large measure, we expected that to be in sectors that are highly reliant on US exports. But clearly, that's not all. That will see a decline in employment because of AI. So we have the oil price shock having a huge negative effect on labor markets, but also a very different kind of fundamental, a longer term fundamental, which is artificial intelligence, is also reducing demand for labor. So this shows you the GDP quarterly out through 2027. You can see the fourth quarter number in in Canada was a disappointing minus 0.6%. We do expect an uptick, not the strong numbers we saw back in 2024, but at least better than the recent past. One incredible change has been a dramatic surge in China's demand for Canadian oil. Now, China did receive much of its oil from Iran, and so China has had a tough time with the blockade of the strait. This is leading them to increase their purchases of Canadian oil. Now, it's still relatively small, but it is a whole lot bigger than it used to be. So you can see that the oil exports to China are picking up even before we expand the pipeline. That is good news. Manufacturing is also another very important component to the economic outlook for Canada. So much of our manufacturing is tied up to exports to the United States. That would be the case with the automobile sector, with aluminum and steel and other sectors. Canada has had a manufacturing recession for 32 months, a very long time. But the new technologies, particularly artificial intelligence and robotics, will improve productivity and profitability. Letting smart machines do much of the routine work will reduce labor demand and increase corporate profitability. And maybe most importantly for Canada, it will increase productivity, which has been underperforming in Canada. Another negative for our economy has been the dramatic decline in population growth, as the government decided last year to all but eliminate the entry of foreign temporary workers and foreign students. We've seen a nosedive in working age population growth. And that is one reason why the slowdown in GDP growth isn't quite as troubling as it might otherwise be, because in terms of per capita GDP growth, it actually moved up in the more recent months compared to last year. So we also see another bit of positive news is that retail sales have rebounded and have been positive for the past 3 months. A good deal of it is automobile sales, but retail sales generally, though moderate, are still positive, which shows that Canadians do, though their sentiment may be at rock bottom lows, they are still spending money. Now, the inflation surge in March was muted. Inflation increased from 1.8% in February to 2.4% in March. The highest in 1 year, but below the forecast of 2.5%. So inflation picked up. It's mainly energy inflation. And some good news is that food inflation, though still 4%, is below the 5.4% the month before. Shelter inflation has been trending downward. But given that inflation did pick up, it's quite interesting that the Bank of Canada continued to hold policy. Now, the Federal Reserve made their announcement at 2 o'clock today, and what's changed there is there were 3 hawkish dissents. In other words, the Federal Reserve Open Market Committee, which is the equivalent of the governing council in Canada, they decided to hold the overnight federal funds rate steady at its current range of 3.5% to 3.75%. However, 3 of the voting members wanted to raise the overnight rate. That's really crucial. And that means that the likelihood of a tightening by the Federal Reserve going forward has risen, given this psychology. You remember, it wasn't too long ago when they were fighting over who was the most dovish and how fast could they lower interest rates. Canadian headline inflation, as I showed you, has moved up very sharply. It could be a whole lot worse, though, and if you exclude just food and energy, inflation is at 2%, the target. And looking at other measures of core inflation, it has trended down very sharply, literally just under 2.5% now. The Bank of Canada did release its monetary policy report today, and in the report, it suggests that we are going to see inflation return to 2% over the course of the next year as economic activity slows initially and then begins to pick up. Looking at the breadth of inflation, this chart shows you the share of CPI components that grow more than 3% annualized, and that share is coming down. It's still an issue, but nothing like it was back in 2022-23. So today's announcement, Bank of Canada holds rates steady at 2.25%. Both the Federal Reserve and the Bank of Canada have elevated risk in a highly uncertain and volatile outlook. The uncertain duration of the Iran conflict is a major factor that complicates monetary policy decisions. And given that no one knows exactly how this will unfold, the banks, the central banks are cautiously conducting policy. They don't want to cause even greater volatility than necessary. So let's talk about our favorite subject, housing. Canada led the pandemic boom in housing, so Canada is leading the correction. You can see here, these are the percent change in nominal property prices in each of these different countries. And you can see Canada, number one. Number two is China. China also had a housing boom, a major housing boom, and has subsequently seen a housing bust, far more dramatic, in fact, than in Canada. But in Canada, it's plenty dramatic enough. So Canadian home prices fall 18% nominally from their peak in the first quarter of 2022. The second largest home price decline was in China, where it was down 17.8% compared to the 18% decline in Canada. Now, housing has a much larger impact on our economy than almost any other economy in the world, and certainly much more than in the United States. Housing is a larger share of GDP in Canada than in the US, and housing in Canada acts as a macro lever. When interest rates fall, housing activity rises. When interest rates rise, housing activity falls. And that's why, and I highlighted this statement, the Bank of Canada watches housing as closely as inflation. I believe that the Bank of Canada is very reluctant to tighten monetary policy in a housing downturn because higher mortgage rates, we have seen small increases in fixed mortgage rates lately, but any sort of dramatic rise in interest rates would be very negative for a housing market that struggles already. And I think the Bank of Canada is correct in assuming that they need an easing bias. They do have an easing bias because of weak housing and consumer confidence. That is a result of all of these affordability issues. So the bank took the overnight rate down for the fourth consecutive time, and the Federal Reserve, they didn't take it down. They held it steady at 2.25% for the fourth consecutive time, as did the Fed. This shows you what the futures market is implying for the 5-year rate. It's the futures market basically implies that 1 year out, the overnight rate will be 50 basis points higher. 5 years out, it will be 100 basis points higher. Now, that doesn't mean that we're going to see this. That's just what markets are predicting right now. So this shows you the forecast curves for the prime rate and for the 5-year fixed rate. And again, you can see from this that interest rates are likely to trend higher, not dramatically so, but trend higher, and variable rates continue to be below fixed rates. Here I show you the trend, the movement, a time series on the gap between the fixed mortgage rate and variable mortgage rates for the 5-year level. Went backwards. So Canadian home sales, again, another disappointment, virtually unchanged in the month of March, up down 0.1%. We also saw a dip in new listings and home prices declined once again. So activity in the Canadian housing market remains subdued, even though we're at the beginning of the spring selling season. So we can be hopeful that things will improve and the fundamentals do gradually improve over time, but it's a long slog. Here we see that the first quarter home sales activity was well below the fourth quarter, and new listings fell in March, although they have been on a considerable uptrend here. And you should also know, look what's happened. This is the 3-month moving average of the proportion of active listings that have been canceled. So not only did new listings dip, but active listings were canceled over the course of the last few months. And obvious reasons is people aren't getting the prices that they had expected. And some discouraged sellers have moved out of the market for a better time yet. But the sales to new listings in March were about unchanged. So this has been a pretty flat figure. And this shows you that condos are still continuing to pile up. This looks at empty condos in Toronto. And you can see this number is huge and it is still growing. So the condo glut is a major factor that's dampening overall housing activity. In March, the home price index also fell further. Home prices are down, as I said, 18 to 20% in nominal terms since their peak in 2022. And real home prices, in other words, adjusted for inflation, are down 30% from their 2022 peak. So housing market continues its long, slow downturn with conditions varying by region and market segment. The weakest, of course, has been in Ontario and then BC, PEI. This looks at the RBC housing affordability numbers. Affordability has improved a bit. That's good news. Affordability improvement is poised to taper off, however, nationwide later this year. So, as you see, we're not going to see much further decline in interest rates, and it looks like from this, home prices will stabilize. So, this shows you the Bank of Canada's estimate of what percentage of income a household would need to cover ownership of homes. So this looks, of course, at the average income level. It would take 88% of average household income to cover a home in Vancouver, somewhat less in Toronto, and then the rest of Canada a lot more reasonable. The gross debt servicing ratios have come down. Homeowners do have borrowing room, but many are or have renewed or refinanced their mortgages over the last year and at higher monthly payments. So people are stretched, and affordability will continue to be a major issue, political issue in Canada. We've also seen that mortgage delinquency rates have moved up. The number now is 0.28%. That's not a high number historically, but it's above where it has been. And interestingly, this wouldn't surprise you, the highest mortgage delinquencies are in Toronto. So this looks at different cities' delinquency rates, and it was for the longest time a problem more in Saskatchewan than elsewhere. And now we see that Ontario or Toronto and greater Toronto area is suffering considerable constraint on the mortgage side. Now, another negative for our economy has been the dramatic slowdown in population growth. You can see here that immigration cuts have clipped housing demand. Unsold new homes are at a 30-year high, and construction costs have surged 70% since the pandemic. So again, and with all of the oil price increases and the dislocation in so many supply chains, prices for the inputs into construction of residential real estate have gone up as well. So the upward pressure, the inflationary pressure is there. Now, it would behoove the governments, the local governments, to work hard at reducing development charges and other costs of construction to make housing more affordable, particularly in Toronto, where there is such a glut. And this shows you that the working age population growth now is absolutely flat, which compared to what we saw back in 2024, 2025, this has been a very, very dramatic development. So finally, I see this weak housing market as a huge buying opportunity. It's a buying opportunity for sure for first-time home buyers, but also for the move-up market, because typically the corrections in home prices will be greater the more expensive the home. And if you're moving up, you may do very well in today's market. You can see that there's a record inventory of unsold homes. Prices have fallen in Ontario, in BC, in Prince Edward Island, and sellers are highly motivated. There's a lot more room for negotiation. There aren't any bidding wars going on anymore. We've already seen major price reductions, flexible closing. People are actually making offers with conditions now, and the offers are being accepted with conditions. A big, big change from what we had seen before. So, Eddie, that wraps it up for now. I mean, there's no telling what Donald Trump has up his sleeve for us over the next few weeks. We meet again the Bank of Canada on June 10th. It looks to me like the Iran war is going to be a fact of life for some time to come yet. And that's a huge factor.
Sure is. Well, I just wanted that last slide you had. I want to talk a little bit about opportunities. And I think there's no better time to get yourself some professionals when it comes to advice. And as you know, DLC Dominion has been around. We're celebrating 20 years. We have mortgage professionals right across the country where we can help you with whatever decision it is that you're looking at making. We have the tools to help you navigate those decisions, be it buying for the first time. And as you say, what an incredible opportunity for first-time home buyers right now, where you don't have to enter into bidding wars. You can take your time, find the areas that you like, and find the house that you always wanted. When it comes up to that move-up buyer, we can talk about what it looks like from you coming out of a mortgage, going into a new mortgage. If you need more excess cash in order to make that purchase, that's something that we can help you with. And the one thing that we didn't talk about today was renewals. There's still a huge amount of renewals that are happening. So when there's this kind of volatility, when you talked about what was the acronym you used? VUCA. We talked about that VUCA. There's no better time than to be in front of a mortgage professional and say, hey, here's my situation. I have a mortgage. Here's my rate. This is what I've been offered. Here's my amortization. This is my situation. What should I do? I can tell you right now, contact the Dominion Lending Center's professional and go through that scenario. Don't do it alone. Sherry, you said it best. What a great way to make a purchase, go through your refinance or renewal, then a mortgage professional at DLC. We can help you do that. You don't have to act alone. So I just want to make sure that came across. You can reach us at www.dominionlending.ca. We can connect you with a mortgage professional and go through, there it is, and go through all that with you. Okay, so man, I took 2 pages of notes. I got so much to ask. There's questions firing in, guys. Keep the questions coming. Sherry, it's just so funny that you look at the consumer confidence that's so low, but yet retail has been really well, like really good. So that's confusing to me. If I'm not confident things are going, you think I'm not spending, I'm saving, or I got an emergency fund I'm working on, but that's not the case. Canadians are spending. How do you explain that?
Well, you never know what the alternative is. You never know what they would have been spending if things weren't so expensive. All of us, I don't know about you, Eddie, but I'm in shock when I go to a grocery store. It's amazing how one bag of groceries can be $100. It's crazy.
Crazy. Absolutely great. I have 5 adults at home. 3 of them are boys, all over 20. My youngest
wow.
21. So when we go grocery shop, we actually have people that gather around the checkout and wait for the price, because it's usually between $600 and $800, and that's every week. It's gut wrenching. But anyways, let's not. This is supposed to be a happy time. Okay, let's get to some questions. I do have some more questions, but we want to make sure that we get the questions. So Jason Nugent, hey Jason, how you doing? If the war continues, oil prices stay elevated, and inflation increases, jobs will continue to fall. But because inflation is up, BOC has to increase rates. Isn't that basically stagflation? That word I've heard a few times.
Right.
You can explain what stagflation is first, and then how does the Bank of Canada work that out?
Great question, Jason. And of course, that's the big fear, stagflation. Stagflation was a fact, excuse me, in the 70s. There was stagnant growth and inflation, which is the worst thing you want to see, because normally you would want to tighten interest rates, higher rates, to break the back of inflation.
Right.
But when the economy is weak and in recession, you sure don't want to be doing that. But as it happened in the US, what forced the policy to revert from stagflation to non-inflationary growth was truly interest rates at super high levels to finally change inflation psychology. And that's way back in the bad old days when we had double-digit mortgage rates, sometimes as high as nearly 20%. So that's not what's going to happen this time.
Thank God.
Yeah, no. Interest rates, part of the reason why interest rates will not return to pre-COVID levels, those low levels, is because the deflation of that decade is behind us.
Right.
For an entire decade, inflation was very low, less than 2%. And in some countries like Japan, they actually had negative interest rates to spur economic activity. So I'm hopeful we won't see that. We're in a better position than most other countries because we're a net exporter of oil, so higher oil prices benefit Alberta, no question. The corporate profitability in the oil patch will be very strong. Job creation there will be very strong. But also, we have the energy we need, although it's expensive.
Right.
There will be many countries, particularly in Asia and parts of Europe, where the gasoline stations will be dry.
Yeah.
And if this were to continue.
Yeah, you're hearing about airlines actually in Europe canceling thousands and thousands of flights because they can't get jet fuel. So that's not going to happen here because not only do we have fuel, but we also, don't we create jet fuel or don't we do something with jet fuel in Canada?
We refine it.
We refine it. Okay, I wasn't sure if we refine it. I didn't want to say that. And then you're like, no, you idiot, it's not refined. But we do refine jet fuel here. So
right.
we are one of the lucky ones in terms of.
Well, we have it, but it's expensive.
It's expensive, but we're not going to cancel flights because we can get it pretty readily, if that makes sense. Okay. So there's one thing that I wanted to just mention because, you know what, I forgot what it was. Let's go to the next question. It'll come to me. Chris Murphy asks, if Trump disruption is international, where does the U.S. stand 6 months from now? Will Russia come out stronger?
What he said was, if Trump's disruption is intentional.
Well, right, intentional. Did I say international? Yeah, intentional.
Yeah, Russia and China have benefited from the Iran war. Believe it or not, Russia and China, because sanctions, and Iran benefited in the sense that the sanctions on their sales of oil were lifted. And Russia, the sanctions on Russia's sale of oil to other countries was lifted because of this disruption. So they've actually benefited. Now, I mean, that was not intentional. There are so many unintended consequences of this war that clearly weren't thought out well beforehand. Anyone would have known, or at least any expert in the area would have known, that number one, oil prices would skyrocket just from the disruption. And number two, that it would take a long time to bring it all back on board, even if Iran were to agree to everything that the U.S. would like to see.
Yeah. And the Venezuelan story kind of just went to nothing, right? I mean, they took the president and thought, you know, there was a lot of talk about how they're going to start, you know, refining or exploring the oil field, but that's all. I haven't heard anything about Venezuela. Nothing.
Well, this has driven that story out.
Right. Which makes sense. Okay, let's get to Sean. Hey, Sean, hope you're doing well, pal. The weak housing market is an opportunity, but for who? Layoffs are happening. Young people are nervous. You know, their jobs, AI, overall feeling like you saw all of those layoffs. I didn't even know about Rogers. Oh my God, half their force? Is that
that doesn't mean they'll accept it. I mean, they're being offered a buyout package.
Right. Okay, so they're offering. They're saying, "Hey, 10,000 if you guys want," and then maybe 1,000 or 2,000. Take it. Okay, I understand. Yeah. Okay. So Sean is saying, like, what's going on here? Are we okay?
Listen, it is tough. There's no question it's tough, but there are still people that have good jobs, that are employed, that have a stable financial situation, and now they've got homes they can buy. It's not like, you know, before when there was such excess demand for housing that you would be in multiple bidding situations and be knocked out time and time and time again. So not everyone is affected directly by all of this. And you need to see it as where the opportunities lie, because just as there's all these dangers and potential losses, there's tremendous opportunity too.
Yeah, Sean, I was in the Niagara region. We just stopped by. They had these $400,000 townhomes. So I was just curious. I stopped by, and they were almost all sold. And I asked, I said, these speculators? They said, no, these are, end users. So in Niagara on the Lake, there's a older buyer or demographic buyer. There's first-time home buyers as well. It's a growing region. There's a big hospital being built there. And he said, yeah, these are end users. These aren't speculators. And, that HST savings, right, on new construction, first-time home buyers, I think it's going to work. I think that there's going to be some, buyers of townhomes that were 750 or 700,000. You take the HST off, and now you're down in the sixes. Like, that's pretty good. I mean, I think that that's
really good.
That's really good. Yes, thank you. That's really good. So that's going to spur on some activity. And I do think these condos, and you saw, I think your chart where there was like housing or condo starts was zero, first time in decades where we had no shovels in the ground. Well, that's all going to catch up. Eventually that inventory is going to be eaten up. It's just a matter of finding the opportunities. And by the way, again, if you're listening here and you're thinking about getting off the fence, talk to a mortgage professional, talk to a DLC agent. They'll help you and they'll walk you through and make sure you feel comfortable. So Sean, I think we're okay.
Eddy, I wanted to make one more comment about first-time home buyers. That first home savings account,
yes,
that is the best tax haven I've seen.
Okay.
Not only is money that you take from wherever else, it could be from your RSP, your TFSA, or just money you put away, and put it into that first home savings account. You get to deduct that amount from your income in terms of the tax deduction.
Right.
And you never have to pay taxes on that money. Unlike the TFSA and the RSP, when you start withdrawing, you have to pay the full income tax, 54% top marginal tax rates. So why wouldn't anybody take the maximum they could and put it into that account? You don't have to use it. If you don't find something you want to buy, the money's yours.
So all the mortgage professionals on this call right now, why aren't you reaching out to your clients and reminding them that? I mean, I think that's brilliant, right? Like there's no better, and you heard it from our chief economist, who I think knows her stuff. There's no better tax haven than that account. Let's get that out. Thanks, Sherry. That's great. Couple more questions. Nina, how you doing, Nina? Can the Canadian government not able to get rid of the stress test to stimulate the market? So there was some chatter about that.
Yeah.
So tell us about, what is the government doing?
Well, they decided not to eliminate the stress test, not because there's some underlying problem in the prudence of Canadian borrowers, but because they are trying to reduce the risk in the Canadian mortgage book for federally regulated institutions. And they're also attempting to put limits on the actual debt ratios of the borrowers, or the debt to income ratios of the borrowers. So I think they just, they're just being overly cautious.
Yeah.
It's like a belt and suspenders.
Yeah, I've seen a few of those in my life. Okay, so I got a few more. I want to get to all the questions. We might go over, guys, just so you know. Carlos, hey Carlos, hope you're well. Thanks for always tuning in and asking questions. Prices going up, product size going down, income increasing and lower rates than inflation, uncertainty from the U.S. tariffs and Iran. You mentioned that Canada is a better position than any other G7 economy. What is your predictions, guess on where all this is going to end?
I actually think Canada's going to do very well in this. Maybe I'm just being too optimistic, but we are a great trading partner because we are reliable. We are stable. We are boring. We don't have, major dislocations in our economy or political, trials and tribulations. If you have an order for Canadian products, those orders are filled. And so why wouldn't you want to trade with Canada? And particularly for products like aluminum and steel and oil and automobiles and on and on. I mean, the only problem we've got is it's expensive to transport those heavy metal bashing kinds of products.
Sure.
And transportation is going up in cost because of the energy crisis right now.
Yeah.
But if I wanted to assure a constant flow of goods and services from a reliable source, Canada's way up there.
Okay, I got two more questions, Sherry. I want to go to Jennifer. I like this one. You know, with consumer confidence declining, homeowners are debating converting their variable rate to fixed. And you had that chart, which was the swap rates, and you saw that prediction, which, by the way, it's just a prediction, guys. That's not exactly what's going to happen.
Right.
It's a prediction, because I have a different prediction, but we can talk about that another day. So what is your general recommendation on this? Should people go from variable to fixed? And I have my sort of opinion on it, but let's hear yours.
Well, I do think that rates are trending higher right now. You know, again, Eddie, there's no one size fits all. Every household has different needs and plans and risk profiles and all of that.
Yeah. And here's what I would say.
That's another reason why you need to talk to a professional, so that that person can get what your 5-year plan looks like and what makes sense for you.
Yeah, absolutely. And Jennifer, and here's what I would say is, you know, if someone really cannot sleep at night and they just feel like, oh my God, if my rate goes up or my payment goes up, then you know what? That conversation of putting them a fixed rate is a really good one, right? Because that's where you want just that peace of mind is more important than anything else. Give them that peace of mind and say, okay, you know what? This is where your payment's going to be. Are you okay with it? Yeah, I am. Okay, let's get you in the fixed. Right? Maybe it's not necessarily the advice you're giving or what I would suggest, but if it's the best thing for that client, then do it. And then, you know, on the other end, if you're saying, okay, well, listen, you have some room here. Your income is good. Your income is strong. Your equity is strong. You know, variable rate right now, yes, it may go up, but you know what? It may go down too. Right? So there is that, you know, maybe it's going to go up, but maybe it's come down. As Sherry said, there's lots going on. So I think it's just a conversation. Your best bet is going through them and getting them comfortable. So that's what I would recommend, is just making sure that they're comfortable and whatever decision they make is going to be a good one, because you'll feel safe that they made the decision. I wouldn't make it for them necessarily. I would help them navigate through it, but hey, let them make the decision. Okay, one more question, then we'll let everyone go. Apologize, 3 minutes over here. Jason asks, what are your thoughts on Warsh? Did I say that right? Warsh?
Yeah.
Being appointed to the Fed. Yeah.
Oh, he's okay. I mean, considering he's been picked by Trump, I think he's less of as they're saying, a sock puppet of Trump's than some other potential choices. He actually voted to raise rates. He would have voted to raise rates. Were he?
There you go. So he's not in Donald Trump's back pocket? No?
Doesn't seem like it.
Doesn't seem like it. Okay. Well, Sherry, I mean, I don't know how you do it, but you do such a great job. Thank you so much for your insights. For everyone else, June 10th is our next meeting. Again, if you need some help, please reach out to a Dominion Lending Center's professional. You can do that at dominionlending.ca. For all of you that keep tuning in, we appreciate you so much. Sherry, I appreciate you so much. Until next time, take care.
Take care. Bye-bye.